Good morning and welcome to the Deep Dive. This is where we take all that market noise, all that data, and try to make some real sense of it for you. Today, we're diving deep, really getting into the forces shaping the start of this week. We're digging into the latest from Bulls, Bears, and the Bell Morning Edition. And the sources, well, they're pretty clear. U.S. equities, they're pointing to a positive open. Dow, S&P 500, NASDAQ 100 futures all looking green. But scratch the surface even slightly and you see something else. A market that feels, well, really conflicted, super sensitive, maybe even profoundly nervous.
Fragility. That's exactly the word. That fragility is, I think, the defining feature right now. You've nailed what we call the fundamental push-pull dynamic. It's happening constantly.
Sure.
Now, you're getting the strong push from very specific company news, big announcements, strategic shifts that are genuinely moving some big, important stocks. But that push, it's constantly being pulled back, or maybe capped is a better word, by these huge, persistent macroeconomic headwinds that, honestly, no single company can just ignore.
Right, the bigger picture stuff.
Exactly. And for you, the listener, getting a handle on this tension is, well, it's crucial.
Right.
Because this feels like the week that tension might finally snap, one way or the other.
We're looking at an absolute gauntlet of high-impact data. I mean, the PCE inflation report, personal consumption expenditures, that's the Fed's favorite measure.
A big one.
And the non-farm payrolls, the jobs report, these aren't just numbers on a screen, they're tests. Political, economic, monetary policy tests all rolled into one. How the market reacts to these, it's going to set the tone for potentially the next few quarters. It's that significant.
Okay, let's jump right into those forces then, our first deep dive segment. Navigating the complex macroeconomic backdrop. The futures market, operating almost around the clock. It gives us that early warning, doesn't it? Shows us how the world is reacting way before New York wakes up. So what are those political pressures really pushing down this morning? Well, the most immediate pressure, I'd say, comes from global trade and geopolitical policy moves. We're definitely seeing the ongoing fallout from trade tariffs. And it's not uniform. It's creating this very distinct picture, winners and losers.
Yeah, the sources highlighted that. A ripple effect, especially in Asia.
That's right. It's quite localized, actually. We saw a pretty clear decline in Asian pharmaceutical stocks, particularly hitting Japan's Nikkei 225, and also certain companies listed in Hong Kong. And this follows specific U.S. policy announcements, things targeting supply chains, IP protection in those key sectors. The fact that the Nikkei is down, -0.39% pre-bell, that links directly back to this. It's not theoretical risk anymore. It's hitting the bottom line for companies reliant on those cross-border flows.
Okay, but hang on. Europe's markets, the FTSE 100 in London, the DAX in Germany, they seem relatively stable, maybe even slightly up. Why aren't they feeling it as much if it's global trade?
Yeah, good question. It really comes down to diversification and direct market exposure. A lot of the big European players, the conglomerates, they have pretty robust localized U.S. operations, production, sales channels, the whole thing. They're kind of structured to absorb some of that tariff risk internally. It makes them less sensitive to the immediate back and forth between the U.S. and Asia. It's a key difference. Global doesn't always mean equal risk.
Got it. Diversification buffering the blow.
Precisely. But there's one pressure point that is hitting everyone, and we absolutely cannot ignore it. Crude oil inflation. We're seeing Brent crude getting close to $70 a barrel, $69.57 last I checked. And WTI, West Texas Intermediate, is up there to $65.21.
And this is just demand picking up.
No, not primarily. This is pretty much pure geopolitical risk premium getting baked into the energy market right now.
Okay, break that down for us. What specific events are driving this particular jump?
Sure. The sources are pointing to two linked things. First, the continued and apparently successful Ukrainian drone strikes on Russian oil infrastructure. And second, Moscow's response to that, which includes halting some fuel exports.
Retaliation.
Exactly. And when you take refined products off the global market because of conflict, it doesn't just hurt Russia. It immediately tightens global supply. Full stop. And that translates directly into higher costs for basically everything that moves. Jet fuel for Carnival's ships, shipping costs for Nike's sneakers coming from Asia, everything.
And that's an inflation driver the Fed can't really touch with rates, can they?
Not directly, no. It seriously complicates their whole inflation narrative. It's a big headache for them.
Okay, so that's the external pressure. Now let's turn inward. The immediate domestic threat, the potential U.S. government shutdown looming October 1st. A lot of people might just see this as, political theater. But why is the market treating it as such a major, immediate economic risk?
Because the market at its core, runs on data, on objectivity, predictability. That's what it craves. If the U.S. government shuts down, key statistical agencies think the Bureau of Labor Statistics, the Census Bureau, they might just stop operating or at least delay everything.
Right.
And that creates what the street absolutely dreads, an uncertainty shock.
Uncertainty shock, Carl.
Think about the week ahead, all that critical data we mentioned, the jobs report, the PCE report, JOLTS job openings. If the government shuts down, it could all be delayed indefinitely. So the Federal Reserve, which keeps saying it's data dependent, suddenly it loses its main inputs. They can't model things accurately. Investors can't forecast properly. You basically remove the objective facts that anchor how we value things and assess risk.
So it's not just the delay itself, it's the vacuum. The lag of information lets fear rush in.
Precisely. You hit the nail on the head. Historically, this kind of systemic uncertainty, it doesn't lead to calm, rational selling. No, it triggers a sharp, sometimes irrational flight to safety. Money just bolts out of growth assets, things like tech stocks and into treasuries or, gold. It acts like this huge weight, capping the bullish momentum we're seeing in, say, NASDAQ futures this morning. It stops any real broad conviction from building until that threat is completely gone.
And that mixed message, it really comes through in that global index snapshot we looked at. NASDAQ 100 futures up nicely, over 0.5%, driven by tech.
Yeah, specific tech strength.
While Asia is clearly weak because of those trade policies we discussed,
Yeah.
the market's trying to buy strength where it sees it,
Yeah.
but the global backdrop is definitely fighting back.
Yeah, it's a tug of war. And that leads us perfectly into part 2, contradictory commodity signal. Because this, I think, is the single clearest sign that the current market strength, it's not really built on broad confidence.
Okay, explain.
We have to look closely at what we're calling the gold conundrum. We know equity futures are up. That usually means investors are feeling optimistic, right? Risk on. Willing to buy growth, take some chances.
Standard playbook.
Right. But at the same time, gold, the classic safe haven, the insurance policy against systemic risk, war, inflation, gold is also trading higher. It's up, 0.77% at $3,838.20.
Okay, wait. That is genuinely weird for a confident market, isn't it? If I'm feeling good buying tech stocks because the economy's strong, why am I also buying gold? Doesn't the usual rule say high confidence, maybe rising yields, means gold should be flat or even down?
You are absolutely right to question that. The traditional relationship is inverse. Rising risk appetite in equities usually pushes down demand for safety assets like gold. So when they rise together like this, it's telling you something important. It's signaling that the market's positive momentum is actually extremely narrow and potentially quite fragile.
Narrow meaning. Specific stocks, not the whole market.
Exactly. It suggests the money flowing into, say, the NASDAQ 100 isn't coming from investors who suddenly trust the whole macroeconomic picture. No. It's likely coming from big institutional funds making very specific surgical bets. Rotations based on really good non-macro news about a particular company, like a huge deal or amazing forward guidance. So they're using one hand to buy that specific stock with the great news.
Yeah.
But with the other hand, they're actively hedging their overall portfolio against all those risks we just talked about, the geopolitical stuff, the potential shutdown.
So the market isn't trusting the economy as a whole. It's just trusting, intel for the next few weeks.
That's a great way to put it, exactly. The current momentum feels tactical, not strategic. If the market was genuinely confident about the PCE report coming up or knew the shutdown crisis would just vanish, gold would likely be under pressure, this divergence. It means the positive vibe is just transactional, really, not fundamental,
Right.
And that makes the market highly vulnerable. Well, any significant disappointment, say, a surprisingly hot PCE inflation number or a really weak NFP jobs report later this week could cause that narrow money to just rush out of equities and straight into those hedges. Suddenly that gold position looks very smart.
A rapid reversal.
And potentially a much sharper market drop than you'd see in a truly confident market.
Right.
It's like the market's buying super fast racing tires for speed, but at the same time strapping this heavy parachute of insurance onto the roof, just in case.
That's a fantastic image. Racing slicks in a parachute. Captures that tension perfectly. Okay, let's shift focus now. From that macro tension to the micro level efficiency in part 3. Decoding pre-market movers. Pre-market action is always so crucial, isn't it? It's where news gets priced in almost instantly, gives us clues about where the real money, the institutional money, might be flowing.
Absolutely. It's price discovery in real time.
And we really need to separate true institutional flow, that push you mentioned earlier, from just, speculative buzz. Looking at the top gainers list this morning, some numbers are just wild.
Yeah.
Driven by retail excitement, small cap stores.
Oh, yeah. Look at the percentages in the microcap space. You've got Meterum Healthcare. Up a mind-boggling plus 189.7%.
Oh, wow.
But look closer, market cap, only $23.2 million. This is classic high-risk, high-reward stuff, probably driven by forums, social media, specific news. Very speculative.
Right.
Another one, Bioaffinity Technologies, up over 80%, plus 81.5% on positive case studies for their diagnostic test. Again, huge move, tiny company, specific news.
And Datavault AI. The Bitcoin supercomputer story.
Yeah, Datavault AI up plus 37.7%, secured a $150 million Bitcoin investment to build a supercomputer. I mean, it's a fascinating headline, definitely grabs attention. But these kinds of moves, as dramatic as they are, they don't really represent broad institutional capital allocation. If Meteoron crashes 50% tomorrow, the S&P 500 isn't going to flinch.
Okay, but contrast that with Intel, INTC, up a much more modest by comparison, plus 4.4% pre-market. Why is a 4.4% move in Intel so much more important than 189% in Meteorum?
Scale. It's all about scale and what Intel represents. Intel's market cap is what, $165.8 billion?
Huge difference.
A 4.4% move in a company that massive, that requires serious institutional capital to get moving. We're talking hedge funds, pension funds, mutual funds making significant allocations. It signals real conviction. And look at the volume. Pre-bell volume for Intel was over 268 million shares. That's a gigantic institutional footprint. And when Intel moves like that, it sends ripples across the entire semiconductor supply chain. Everyone notices.
And the catalyst driving it.
The catalyst seems to be reports that Intel is actively seeking new high-profile investment partners. Names like Apple, TSMC, Taiwan Semiconductor Manufacturing are being thrown around. Plus, potential benefits from chip tariffs. This isn't just a small news item. It's a potential strategic pivot for a giant. And when big institutional money buys into a strategic pivot like that from a company like Intel, it's a strong sign of sector rotation. And that is likely what's really providing the push for the NASDAQ 100 futures this morning. It's specific, it's high-quality buying.
Okay, that makes sense. Now let's flip it. Look at the top losers. If the gains are often about hope and news, the losses, well, they often reveal some hard financial truths. What's the pattern driving the biggest drops today?
Well, there's one pattern that's incredibly instructive, especially for anyone learning about the market. Equity dilution. It happens again and again. It's predictable, and the impact on the share price is almost always immediate and negative.
Dilution. So the company issues more shares.
Exactly. They issue new shares into the market. This increases the total number of shares outstanding, which means each existing shareholder's piece of the pie gets smaller. Their ownership stake is diluted.
Can you give us a clear example from the sources today?
Sure. Luxaria Bioscience Corp., it's down sharply, negative 22.2%. And the catalyst, a very clear announcement. A $4 million registered direct offering. Think of it like this. If a company is a pie with 10 slices, and you own one slice, you own 10%. If the company suddenly creates 3 brand new slices out of thin air and sells them to someone else to raise cash, well, you still have your original slice, but now there are 13 slices total. Your ownership just dropped from 10% to about 7.7%.
Ah, so the market instantly adjusts the price of your slice downwards to reflect that.
Precisely. Companies usually do this when they need cash quickly, maybe for operations, maybe to pay down debt. Often it signals they're in a tight spot, which is kind of a double negative signal for existing shareholders.
Right. It might be necessary for the company's survival long term, but it's an immediate hit to the stock price.
Right.
That's a really crucial lesson.
Absolutely fundamental.
We also see some other big drops, like Concentrix Corp, Wolfspeed, down 21%. We had less clear catalysts there, but that dilution example with Luxaria is crystal clear.
Yes, it's a textbook case.
Okay, so we've laid out this fragile foundation, right? Built on these specific micro catalysts, but underneath, there's all this macro fear. Now, let's brace ourselves for the big test in part 4, the economic gauntlet. This week's economic calendar. It looks absolutely unforgiving.
It really does. High stakes all around.
And the market doesn't just sit on his hands waiting for Friday's data dump, does it? Traders are going to be watching these leading indicators all week, trying to build a narrative. So, Tuesday, 10:30 a.m., we get JOLTS job openings. Why is that specific report so important for the Fed?
JOLTS is the Job Openings and Labor Turnover Survey. It's really the Fed's best measure of labor market demand. It tracks how many jobs are open, who's getting hired, who's quitting or being laid off. The Fed has been laser focused on things like the quit rate and especially the total number of job openings. If openings are super high, it suggests employers are desperate for workers, which pushes wages up.
High wages mean sticky inflation, especially in services.
Exactly. So if JOLTS finally shows openings cooling off significantly, that gives the Fed some breathing room, maybe ammunition to pause rate hikes. It's a key piece of the puzzle for them.
Okay. Then Wednesday, also 10:00 a.m., we get the ISM Manufacturing PMI. Why is this one a must-watch?
Because the ISM PMI is forward-looking. It's based on surveys of purchasing managers, the people actually placing orders. The magic number is 50. Above 50 means expansion. Below 50 means contraction.
And the last reading was below 50, wasn't it?
Yeah, prior was 48.7. So if this week's reading dips further, say down to 47 or 46, that's not just manufacturing slowing down. That's a big flashing warning light for a potential recession. That could trigger a flight to safety pretty quickly, even if company earnings look decent.
Right. These reports build the tension leading up to Friday. So let's really dig into Friday. Both reports drop at the same time, 8:30 a.m. Eastern. Intense.
Yeah, Friday morning is basically the monetary policy Super Bowl. You get the non-farm payrolls, NFP, and the unemployment rate together. The consensus forecast for NFP, the headline job number, is around 75,000 jobs added. Now, that 75K number is interesting because it's often seen as roughly the number needed just to keep pace with population growth.
Okay, so baseline replacement level, almost.
Kind of. So if the number comes in way above that, say over 150,000, it suggests the labor market is still running hot. That's hawkish for the Fed. But if it comes in really weak, say below 50,000, especially if the unemployment rate ticks up too, well, then recession fears jump right to the front burner. Either way, expect massive volatility around that release.
Guaranteed. And the other Friday report, dropping at the exact same time, the personal consumption expenditures, PCE, you said that's arguably even more important for the Fed's thinking. We need to unpack that. Why PCE over the CPI, which everyone hears about more often?
Yeah, this is a really important distinction for listeners to grasp. The CPI, the Consumer Price Index, it measures price changes for a fixed basket of goods and services. Like, they decide what's in the basket and track those specific prices. The PCE, on the other hand, allows for what economists call the substitution effect.
Substitution, meaning people switch products.
Exactly. So if the price of beef skyrockets, the CPI just registers that big price increase for beef. The PCE model assumes, probably correctly, that some consumers will say, forget beef, I'm buying chicken this week because it's cheaper. And it adjusts its calculation to reflect that shift in actual spending patterns.
So it's maybe a more realistic picture of what consumers are actually spending and feeling.
That's the argument. It tends to result in slightly lower inflation figures than CPI, and the Fed considers it a more accurate reflection of consumer behavior under price pressure. Plus, PCE covers a broader range of spending, especially on services and healthcare, and right now, the Fed is most worried about that sticky services inflation.
Okay, got it. And the forecast for PCE this Friday.
The consensus is looking for a month-over-month increase of plus 0.3%. The big risk here is a hot print, maybe plus 0.4% or even plus 0.5%. If that happens, the market will likely just slam the door shut on any near-term rate cut hopes. It cements that higher-for-longer narrative and really hammers valuations, especially for growth stocks.
And just to make things even more complicated, the sources mentioned multiple Fed officials are speaking this week. Hammack, Musalem, Williams, Bostic. Why do we listen so closely to their speeches before the data even comes out? Couldn't they just wait?
Haha, well, they could, but they don't. Think of it as real-time sentiment management or maybe expectation setting. The market hangs on every single word, looking for any tiny shift in tone. Is someone sounding a bit more hawkish, a bit more dovish than last time? For example, if, say, Governor Bostic gives a speech on Monday and sounds unexpectedly worried about wage growth before the JOLTS data on Tuesday, that primes the market. If JOLTS then comes in hot, the reaction might be even more severe because Bostic already put that worry out there.
So their words amplify or dampen the reaction to the actual numbers?
Exactly. Their speeches are like running commentary. They guide expectations, maybe try to prevent overreactions, and traders read between every single line, looking for clues about the Fed's next move.
Okay, fascinating. So we've covered the top-down pressures policy, macro data, Fed speak. Let's shift now to part 5, corporate health check. This is the bottom-up view, right? The earnings reports that tell us if the companies themselves are seeing what the macro data suggests.
Absolutely vital. It's the reality check. And as we said earlier, the market is purely forward-looking. A company can beat its historical EPS estimates, have a great quarter looking backward,
Yeah.
but if its forward-looking guidance for the next quarter or the rest of the year is weak, if they start talking about rising costs, slowing demand, inventory problems, that stock is likely going down.
Right. It's all about tomorrow, not yesterday.
Always.
Okay, let's break down some key earnings reports this week and what traders will be zeroing in on. Starting with Carnival Corporation, CCL. They report Monday morning before the bell. Why is a cruise line so significant right now?
Carnival is a fantastic proxy for discretionary consumer spending, particularly for that middle to upper income bracket. Traders will look way past just the headline revenue number. The really critical metric is forward booking trends. Are people booking cruises 6, 12 months out? That tells you about confidence.
And not just booking, but at what price, right?
Exactly. Are they paying higher prices for those future trips? If Carnival says bookings are strong and pricing is holding up, that's a powerful signal. It suggests the consumer is still pretty resilient, absorbing inflation, maybe higher student loan payments, but still willing to spend on travel. But if they report strong bookings only because they're offering heavy discounts, deep promotions, that's a red flag. It suggests consumer elasticity is cracking. People want to travel, but only if it's cheap. And that would be bad news for the whole consumer discretionary sector, including Nike later in the week.
Okay, good point. So Tuesday, we get a doubleheader. Nike, NKE, reports after the close, and Paychex, PAYX, reports before the open. Very different companies giving us different views. Let's start with Nike.
Yeah, for Nike, the focus is kind of twofold: geography and margins. First, everyone will be watching China market momentum. China is still a huge growth driver for them. Any sign of slowing sales there or maybe increased local competition, that'll weigh on the stocks.
Still key.
Absolutely. Second key metric, gross margin performance. Nike's had some issues with inventory pileups and needing to discount heavily in the past. So if their gross margins are strong this time, it means they're selling shoes and apparel closer to full price. That signals good brand health, good pricing power.
Makes sense. And Paychex, a payroll processor. Sounds a bit technical, but you flagged it as having big macro implications.
Oh, Paychex is arguably one of the most interesting reports this week from a pure macro viewpoint. They handle payroll and HR mostly for small and medium-sized businesses, SMBs. So their data on payroll client growth and the total number of employees they service acts like a direct, almost real-time proxy for the health of the private sector job market, especially among smaller companies.
So it's like a sneak peek before the official NFP report.
Exactly. If Paychex comes out on Tuesday morning and says, hey, we're seeing a slowdown in new client signups, or the average payroll size per client is shrinking, that data hits the wire immediately. It can instantly change expectations for Friday's big NFP number. It's verifiable data about hiring trends at the ground level, an essential barometer.
Wow. Okay. That's a really important one to watch then. Finally, Wednesday morning, Conagra Brands, CAG Packaged Foods. Might seem a bit boring, but you're saying it gives us a deep look at the core inflation battle.
It absolutely does. Conagra makes all those frozen meals, canned goods, snacks. It's a perfect test case for consumer elasticity. We're looking at that balance. Can they keep raising prices without losing customer?
The pushback point.
Right. Food companies have been pushing prices up aggressively for, 2 years now? If Conagra reports that their sales volumes are holding up reasonably well despite those higher prices, it suggests consumers are kind of accepting it. They're not massively trading down to store brands or just buying less. But if Conagra says sales volumes fell off a cliff because of the price hikes, that tells you consumers have finally hit their limit. They're pushing back, trading down. And that signals trouble not just for Conagra, but potentially for the whole consumer staples sector. It's a crucial read on inflation's real impact.
Okay, fantastic breakdown. We've looked at the ground level with earnings, the high level with the Fed, and macro data.
Okay.
Let's try to tie it all together now in part 6. Integrated synthesis and strategic outlook. This is where we connect the dots, right? Link specific data points to actual trading risks.
Yes, this is the critical step. Making those connections, understanding how, say, an inflation report actually translates into performance for different parts of the market. We need to watch 3 key cross-asset relationships this week.
Okay, what are they?
First, inflation and technology. This really boils down to valuation math. If that PCE report on Friday comes in hotter than expected, signaling inflation is stickier than hoped, the market reaction is immediate. It prices in higher for longer interest rates, and that causes Treasury yields to spike.
Right. And why does that hit the NASDAQ, the tech stocks, so much harder than other sectors?
It's all about the discounted cash flow DCF model that's heavily used to value growth stocks, which dominate the NASDAQ. That model tries to figure out what all of a company's projected future earnings are worth today. To do that, it uses an interest rate, the discount rate, to bring those future earnings back to the present. When interest rates go up, that discount rate goes up.
So future money is worth less today.
Exactly. And the further out those projected earnings are, which is typical for fast-growing tech companies investing heavily now for profits years down the road, the more aggressively they get discounted by higher rates. Even a small rise in treasury yields can shave billions off the theoretical value of a high-growth tech stock, while maybe having a much smaller impact on, say, a stable utility company with predictable near-term cash flows.
Got it. So hot PCE equals immediate pain for tech. What's the second relationship?
Second, jobs and the dollar. If Friday's NFP report is surprisingly strong, let's say well over 150K, maybe closer to 175K or 200K jobs added, that tells the Fed, okay, the economy can handle these higher rates, we don't need to cut anytime soon. High U.S. interest rates tend to attract investment capital from around the world as investors seek better returns. That increased demand for dollars pushes the value of the U.S. dollar higher.
If in the stronger dollar.
Makes U.S. goods more expensive for overseas buyers, so it can hurt the international sales of big multinational companies, particularly exporters or companies like Nike that rely heavily on foreign markets.
Okay. Inflation tech, jobs dollar. What's the third?
The third is maybe the simplest, but also the most direct. Oil and the consumer. This is pretty straightforward. Those continued increases in crude oil prices we talked about, driven by that geopolitical risk, they act like a tax, a mandatory tax on almost every consumer.
Yeah, you feel it at the pump immediately.
Right. And every extra dollar someone spends on gasoline is a dollar they can't spend on something else, a vacation, new clothes, eating out. It directly squeezes discretionary spending. This puts downward pressure on the outlook for companies whose earnings depend on people having extra cash for non-essential purchases. It just reinforces the risk we talked about for companies like Carnival, Nike, and others in the consumer discretionary space this week.
Okay, that's crystal clear. So given all this tension, the shutdown risk, that weird gold signal, the massive data coming, we really need a strategic roadmap. What are the main ways this week could actually play out? What are the key scenarios?
Yeah, given the setup, you absolutely have to be prepared for, I think, 3 distinct potential outcomes. Scenario 1 is the bullish scenario. This is the everything goes right version. First, the political drama gets resolved. The shutdown is averted or at least kicked down the road, removing that uncertainty cloud.
That's the point.
Step 2, we get that Goldilocks economic data, meaning PCE inflation moderates, showing the downward trend is intact, but the jobs report is still resilient, maybe around that 75K, 100K mark, confirming soft landing hopes, not a recession.
Not too hot, not too cold.
Exactly. And step 3, key earnings reports, like Carnival and Nike, need to deliver strong results and strong forward guidance. If all of that lines up, then the market might finally have the conviction to break out and sustain a rally, probably led by tech and consumer discretionary.
Okay, that's the dream scenario. What's the flip side? The bearish scenario.
That's the nightmare convergence. Everything goes wrong at once. A government shutdown actually happens, blinding the market with lack of data. Then the PCE report comes in scorching hot, forcing the Fed into an even more aggressively hawkish corner. And crucially, that hot inflation gets paired with a weak NFB number, confirming stagflation fears, rising prices, and a slowing economy. Or just outright recession fears.
Yes.
Yeah. That combination would likely trigger a sharp, deep market correction. All that institutional money that tentatively flowed into Intel, it would probably rush straight out and into true safe havens, treasuries, gold. It could get ugly fast.
Okay, bullish, bearish. Which
Yeah.
is the most likely path? The base case.
The base case, and probably the most likely given the current tensions, is defined by one thing: continued high volatility. In this scenario, the shutdown risk probably gets resolved, but maybe at the last minute, with lots of anxiety along the way. The market then spends the week trying to digest conflicting signals. You might get strong execution from specific companies. Maybe Nike posts great numbers, but that gets offset by macro uncertainty from, say, a disappointing ISM manufacturing reading or oil prices staying stubbornly high.
So a push-pull, basically.
Exactly. The market struggles to find clear direction. It probably chops around, maybe sideways to slightly lower overall. And in that kind of environment, performance becomes highly dependent on picking the right individual stocks with strong specific catalysts. It demands very active, very surgical management, not a set it and forget it week.
Definitely not. Wow. Okay, That deep dive has given us an incredibly valuable guide for navigating what is shaping up to be.
Well, one of the most consequential starts to a quarter we've seen in a while. I think the key takeaway here for you listening is really clarity over complexity. This week is a fundamental test of the market's underlying resilience. It really demands you pay close attention to the interplay between these factors, not just the individual numbers. How do corporate results line up with the macro data? How does the PCE number affect Fed expectations and tech valuations? How do geopolitical shocks feed into oil prices and consumer spending? It's all connected. And like you said, definitely not a week for passive investing.
Absolutely. So to wrap things up, we want to leave you with one final provocative thought, something that ties back to that fragility we started with. We talked about the market simultaneously buying gold, the insurance and equity futures, the growth bet. We saw two very different kinds of strength today. Intel's move, representing huge institutional capital backing a strategic shift, and Data Vault AI's speculative surge fueled by a Bitcoin investment. So the question for you to ponder is this. Which of those two forces the massive, slower-moving institutional conviction behind a name like Intel, or the fast, headline-grabbing, speculative momentum we see in smaller names? Which one do you think is actually the single most powerful factor preventing a broader, more fundamental market retreat to safety right now? Where does the real conviction lie in this fragile, uncertain environment? Something to think about.